This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This lecture is on chapter 24 of the free paper F2 lecture notes, and it's on variance analysis. And I did introduce variance analysis in a simple way when we did the chapter on budgeting. But as you'll see when we go through this chapter, there is a lot more work involved, a lot more calculations. And although it may look a very short chapter, there are only 2 pages, we're actually going to do quite a lot. It's a desperately important bit of the syllabus and is bound to be a fairly large part of the exam itself. So it would be useful for you to have some paper with you, and then you could do it with me. However, to explain or remind you a little bit about what's going on, look at example 1. It says a company's prepared the following standard cost card. So it's fairly conventional: materials, 4 kilos, $4.50 a kilo, $18. There's labour, there's variable overheads, there's fixed overheads. They've got a budgeted cost per unit, a standard cost of $68. The budgeted selling price is $75 a unit. And they were budgeting on producing 8,700 units and selling 8,000. And so I think fairly obviously, if they're producing more than they're selling, they're expecting closing inventory of the difference of 700. So that's what we're budgeting on happening. And before I read the rest of it, just 2 things. First of all, do note that this company is using absorption costing, because on the cost card, they've absorbed the fixed overheads. You can see they've been absorbed on an hourly basis. There's 5 hours of labour, there's 5 hours of fixed overheads at $3 an hour. They've absorbed $15 a unit. So it is absorption costing, which is going to be very important as we go through. It could have been marginal costing. I'll explain later what differences there'd be to what we're doing if it's marginal, but it is absorption costing. And secondly, let's just write down quickly how much profit they're budgeting on. Surely the budgeted profit is what? Well, the sales, they're budgeting on sales of 8,000. The standard profit per unit well, the selling price, it says there's a budgeted selling price of 75. The standard cost is 68. So they're budgeting on making a profit of $7 a unit. 8,000 units at $7 is 56,000. So that's the budgeted profit. However, the actual results, if you go back to the question, are as follows. We actually sold 8,400 units and produced 8,900. So we sold more than we expected. We sold them for $613,200. We'll check later. But they were supposed to sell them at $75 a unit. Maybe they sold them for more, maybe for less. And we've got there all the costs that were incurred: materials, labour, variable and fixed. Well, if you remember from that budgeting chapter, the actual costs clearly could be different from what we were budgeting. And for all those reasons, the actual profit may turn out to be different. And so ultimately, with variance analysis, our job is to explain why the actual profit is different than the budgeted profit. And let's do what we did in that earlier budgeting chapter. And what this question asks for, first of all, it wants us to prepare a flexed budget. And so what I'm going to do is just what we did in that earlier one. I'm going to write down the original fixed budget, And then I'll remind you what we mean by a flexed budget and how we go about it. But just so we don't get lost, remember the original budget, we had sales of 8,000 units. We were budgeting on producing 8,700 units. And so let's write up a full profit statement. First of all, the sales revenue. Remember, this is the original fixed budget, so we were budgeting on selling at 75 a unit. 8,000 units at 75. We were expecting revenue of 600,000. To get the profit, we need the cost of sales. Well, let's write down first of all the cost of production. And remember, they were budgeting on producing 8,700. And so the cost of production, well, materials, 18 a unit from the cost card. So we expected to spend 156,600. Labour, again from the cost card, $25. So 8,700 at 25 is 217,500. Variable overheads, we're budgeting at $10 a unit. 8,700 units at $10 is 87,000. And finally, remember it's absorption costing, so fixed overheads, $15 a unit. 8,700 times 15, 130,500. And so the total cost of production, 156,600 plus 217,500 plus 87,000, 130,500, is 591,600. And of course I could actually have written that straight down because the production is 8,700 units. The cost per unit should be $68. 8,700 at 68, 591,600. However, that's the cost of the 8,700 produced. In order to get the cost of the 8,000 that was sold, we need to subtract the closing inventory. They produced 8,700, they're selling 8,000, so the closing inventory is 700 units. And the cost per unit, $68. 700 at 68 is 47,600, giving a cost of sales of 544,000, and therefore a profit, the original budgeted profit, 600 less 544, 56,000. Which I already knew. But you know, if you ever asked to write up a full profit statement, there we are. Although obviously only do it if you've asked for it. We know what the actual results were. And remember, what we're trying to do is compare actual with budget and see if we've overspent or underspent. But to compare as they stand, if you remember, it'd be silly. For instance, the actual expenditure on materials is 163,455 if you look at the question. We only budgeted on 156,600. But obviously, we're going to spend more than budgeted because we actually produced more. It's silly to criticise the relevant manager for spending more. When we produced more, it's not their fault. And so to make the comparison sensible, we flex the budget. And by flexing, we rewrite the original budget but based on the actual sales, the actual production. So what were the actual sales, actual production? We actually sold 8,400 units. We actually produced 8,900. So let's now rewrite the original budget. So the sales revenue, 8,400, the selling price should be 75. And so we should have had revenue of 630. The costs of production, well, we produced 8,900. Materials should be 18 a unit, which is 160,200. Labour, 8,900 at 25 a unit, should be 222,500. Variable overheads, 8,900 at $10, 89,000. And finally, fixed overheads. Now this might worry some of you, but be patient with me. 8,900 at $15, 133,500. Now, if you are getting worried there, please be patient for a minute. But accept how I got the figure. I multiplied 8,900 production by the $15 a unit for fixed overheads. I will come back and say more about that in a minute. But it means that the total cost of production comes to $605,200. That's the cost of production, but of course we want the cost of the 8,400 that was sold. And so deduct the closing inventory, which this time there are 500 units, produced 8,900, sold 8,400. At $68 a unit, 34,000. So the cost of sales, 605,200 minus 34,000 is 571,200. The profit, therefore, $58,800. Now then, understandably, a lot of people get upset about the fixed overheads because, of course, by definition, fixed overheads should stay fixed, whether we produce more, whether we produce less. And so the profit, we don't expect really to be 58,800 at all, because we've put in 133,500 for fixed overheads, and it should stay fixed at 130,500. If you remember the lectures on absorption costing, we always have to make that adjustment for under-over absorption, and it's something we're going to have to explain here shortly. But the reason we've done it is this. From the original budgets, management are expecting a profit of $8 a unit. They expected the selling price to be 75, the cost to be 68, and so I did write down earlier. The budgeted profit was the 8,000 units they expected to sell. Per unit, 75 minus 68 is $7. And so they were expecting to make 56,000. Our job shortly is to explain why we don't make 56,000. And the most obvious reason is we sold more. And surely management are going to think, how many did we sell? 8,400. You told me the profit we expected was $7 a unit. And so they're going to be expecting rather to make 8,400 times 7, 58,800. I've already said, even if everything else went perfectly, it won't in fact be 58,800 because of these fixed overheads. Well, as you'll see, we will explain that effectively to them later. However, having done the flexed budget, now it does make sense to compare what actually happened with what should have happened. So let's now look at the actual results. Obviously, we did sell 8.4 and produce 8.9. But how much revenue did we actually earn? The question tells us we sold 8,400 units for 613,200. We'll look at that in a minute, but obviously we got less revenue than we should have expected. What about the costs, though? Materials, we actually spent 163,455. Labour, 224,515. Variable overheads, 87,348. Fixed overheads, 134,074. So the actual cost of production, the total of those, 163,455, 224,515, 87,348, 134,074, 609,392. But that's the cost of the 8,700 produced. 8,900 produced. Again, we need to subtract the closing inventory of 500 units. And whatever the actual cost of production turned out to be, we always, certainly in variance analysis, we always value the closing inventory at the standard cost of 68. I'll say a few words about that in one moment. But a standard cost of 68, closing inventory is 34,000. Therefore, the cost of sales, 575,392. And therefore, the actual profit, revenue 613,200 minus the cost of sales 575 is 37,808. The closing inventory, I said we value it at standard cost, which here is $68 a unit. Remember, we're not doing financial accounts. Financial accounts, you'd value the inventory at actual cost. But here, you see, variance analysis, we normally do this exercise monthly. And so some months we might spend a bit more than we should, some months we might spend a bit less. We're not going to change the inventory values every month. It would be silly. And so we assume that overall the inventory value is fine at 68, and we carry on valuing at 68. Finally, though, remember, management want to know why the profit wasn't 56,000. We flexed the budget, so because we sold more, they're expecting we make 58,800. But now we can compare line by line. Did we pay the right costs or whatever? We look at the differences or the variances. Sales, we should have got 630,000. We only got 613,200. We must have sold at less than $75 a unit, but it's lost us the difference of 16,800. And because it's lost us money, that on its own would mean less profit. And so we write against it A for adverse. A stands for adverse and means less profit. What else went wrong? Materials, we should have spent, for our production, we should have spent 160,200. We actually spent 163,455. The difference, 3,255. And again, because we overspent, that on its own would mean less profit. It's adverse. Labour, again we've overspent. 224,515 minus 222,500. 2015. And yet again, an overspend means less profit. It's adverse. Variable overheads. Oh, we've saved money. 89,000 is what it should have been. Less 87,348 is 1652. And here, because we've spent less, this on its own would give more profit. And so we write against it F. F stands for favourable. It's favourable if the difference results in more profit. Finally, what about fixed overheads? I've already said we know there's a problem, but the flex budget was 133,500. We actually spent 134,074. So arithmetically, an overspend of 574, it's an overspend, it's adverse. And just as a double check on ourselves, the net total of those variances should explain why the actual profit was different than the flexed profit. And so let's check. It was 16,800 adverse, another 3,255 adverse, another 2,015 adverse, less 1652 favourable, plus another 574 adverse. I get a total of 2992 adverse. And it's simply as a double check. Does it explain the difference? Well, 58,800 minus 37,808. 2922. So there is our flexed budget. Again, remember we're doing absorption costing, but there's our flexed budget. And these variances, well, sorry, I'll write it above. We've calculated the total variances. However, the reason we've a lot more work to do now is just look at materials for a minute. We obviously overspent. We should have spent $18 a unit. We spent more. But why? Management will want to know, why did we overspend? What was it that went wrong? And the reason it was $18 a unit, the standard cost, the cost card says it's 4 kilos. It says we should be spending $4.50 per kilo. And that's why it's 18. Well, I say again, we obviously spent more than 18. But we need to know why. Maybe it was because we paid too much per kilo. Maybe we paid $4.60 a kilo or something. And that's going to be the responsibility of the purchasing manager. Or it could have been, we did pay $4.50 a kilo, but we used too many kilos. And that's maybe the fault of the production manager. Or it could be a combination of the two. And so as you'll see in the next lecture, because I'm going to have a break here, but in the next lecture we're going to carry on. And we're going to look at each of those variances and analyse them, try and find out that overspend. How much of it was because we paid too much per kilo? How much of it was because we used too many kilos? So, I say that's in the next lecture where we'll go through them one by one.